Hi, I'm Ron Rohde with Ronald Rohde Law, and today we're going to be presenting a webinar, When Do I Need or Why Do I Need an LLC for My Real Estate Investing? And today we're joined by Daniel Hyman, who is a CPA and the founder of My Online Accountant. This is his own practice. He's built it up with, I've known Daniel for a few years now, and it's just been great to watch him grow, as we've both grown in our practices. And they provide a variety of bookkeeping and tax return services. So Daniel, tell us a little bit about what you do.
Sure. First of all, thanks for having me on here today, Ron. It's great to join with you. So as you mentioned, we're a full-service CPA firm. We do specialize in the real estate space. So our typical client will be a W-2 earner with a rental or two on the side. We also work with flippers, wholesalers, real estate agents, that type of thing, to help out with bookkeeping, taxes, advisory services as needed. And it's all performed virtually, so our CPAs are scattered throughout the U.S., and all services are provided to clients throughout the U.S. as well.
That's great. That's fantastic. Yeah, I think that your model is definitely something to aspire to. It's similar to what I've kind of grown with my practice. I have staff, I have a lawyer in California, and a lot of what we do on the intake process is we do these Zoom calls. I do Zoom calls with new clients. Everything is digital. We don't have paper files. So I have a client portal where I share documents. People do DocuSign, digital signatures, and it's really, I think the modern way to do this is you want a online cloud-based storage for all your legal docs. In the same way for your account, you want all your tax returns online in one place without having to worry about where did I put that shoebox full of receipts. So without further ado, let's kind of go into it. It's going to be kind of a Q&A, but we really want this to be informative. And I think that what you can take away as a viewer is if some of these metrics or these descriptions fit your real estate investing current situation or your goals, then you can take away these pieces of advice and kind of pick and choose and apply them as needed. Because, for example, we're going to talk about somebody that has a W-2, somebody that has a long-term tenant. Well, this may still apply to you if you have a W-2, but you're doing Airbnb. A lot of that structure is similar, but you'll want to check in with us and say, how does this differ for my goals, which are, slightly different but similar. So talk to us, Daniel, I guess a little bit about what you see with your clients coming in. They have a residence. Do they need an LLC? Do they all have an LLC when they come to you for bookkeeping?
Sure. Not all do, but some do. And one of the reasons why I was so excited to shoot this webinar with you, Ron, was because I'm constantly speaking to clients about the pros and cons of an LLC, but I can really only speak to the tax implications of the LLC. And I sort of give that disclaimer to the clients when I speak to them is that, hey, there's two sides of this. There is the tax side and there's the legal side. Now, not always are those two sides going to see eye to eye, but sometimes they will. And you just want to be able to loop in both your attorney and your tax advisor to know what's the best option for you and how to balance both the legal and the tax side of that. So I think it's a very important topic, one that I'm really excited to talk about. I think that, and it's like anything in these areas, there's no one size fits all, right? Now, when you and I were talking about what our sort of target market for this particular presentation is, we discussed a typical client who may have like a W-2 and a rental or a handful of rentals, and they're really not quite sure, hey, where do I go with this? Now, do I create the LLC? Do I create multiple LLCs? And so they're coming to me as the tax advisor and you, Ron, as the legal advisor. So I can only speak on the tax side. So I guess I can just kind of go with that sort of.
Yeah, I mean, so on that point, I want to expand a little bit. your accountant and the bookkeeper, their goal is to reduce your legal tax obligation to as low as possible. And I think that, that's kind of the overarching goal. As a lawyer, my overarching goal is to minimize liability and exposure. And those are two different goals. And like you mentioned, sometimes they're at odds. So for example, if I'm trying to minimize my client's exposure to liability, I might go ahead and spend 10, 15,000 on creating all these complicated trusts and anonymous incorporations, overseas entities. I can do a really good job of creating a huge web and a series of walls, but it's not going to be very easy for you to file your tax return. It's not going to be cheap, and it might not make sense for the amount of equity that we're trying to protect. And that's really that conversation that you need to have with your lawyer and your accountant and your CPA to figure out what are you trying to protect and what level of each do you want to take? Do you want to really minimize your taxes, or do you want to maximize your liability protection? Because that's an example where they're not always down the same path. They're a little bit opposed. So yeah, tell us, this is a really common question. Can I get more deductions with an LLC?
Yeah, and that's a great question. The answer is that it's really going to depend on what type of LLC. Now, an LLC is a state concept, right? It's a concept that's recognized by the state, an entity that's formed, but the IRS doesn't recognize the LLC as its own distinct tax
status. Yeah.
So an LLC can take on various forms on the federal level. So an LLC could be what we call either a disregarded entity, meaning that the IRS just disregards that entity. It's part of the individual tax return, and it doesn't get its own separate tax treatment. An LLC can also opt to be taxed as a partnership. So if with multiple members, the default tax treatment of that LLC would be as a partnership, and that would get a separate tax return. Alternatively, it could be elect to be taxed as an S corporation, which we might get into a little bit later, and that's sort of its own separate animal. For the most common type of LLCs that we see, Ron, it's going to be a disregarded entity. Yep. It's going to be an individual who has a W-2, but he has a couple of rentals, and maybe he wants to protect, and I think you'll probably be able to talk about that side a little bit more, but he wants to protect everything else he has going on, his other assets. So he opts to create the LLC and then purchase properties in that LLC, or he or she might purchase the properties initially, then create the LLC, and then quit claim the deed into the LLC. Now, to answer your question about the taxes for the deductions for that type of LLC, there's actually not going to be any special or preferential tax treatment for that single member LLC that's a disregarded entity.
Okay.
In an LLC or out of an LLC, you're still going to get your all of your normal, ordinary and necessary expenses. You're going to get your depreciation. You can claim the home office deduction. So a lot of the normal and ordinary and necessary expenses, you're still going to be able to claim. And so in that regard, I believe an LLC for a single member disregarded entity would simply be more of an asset protection strategy.
Yeah. So bottom line, you're not losing any tax deductions, and in some ways it might make it easier to categorize and track those deductions. But yeah, it's a small cost that has no tax penalty, so to speak. And your rates for filing that Schedule E are comparable or the same. So it's just a minimal increase in the annual cost versus the benefits. And so, I'll talk a little bit more about the benefits. A lot of my clients come to me, or new clients, and they say, Ron, do I need an LLC? I have one property. I have one single family, or maybe I have a duplex. And to those questions, I answer with another question. It's a good lawyer trick. But it's really not dependent on the number of properties that you have. It really should depend on how much equity the owner is trying to protect and what type of risky investing behavior they're participating in. So let me give a real quick example. You have a W-2, you're buying a property with putting debt. If you're buying this with a mortgage, you're not going to cash flow a ton necessarily, a few $100s, maybe 700 if you're good. The cash flow is not great, but you're paying down the debt and you're building equity in a property that is on cruise control. This with a long-term tenant, you have a property manager. This is really a strong investment. Now, the equity in that type of investment might only be $50,000. And I would probably say for $50,000, you don't need an LLC. Slap a 1 or 2 million umbrella policy on there, keep it in your name, get the low interest rate financing, and you're done. The situation changes though if you have a lot of non-tax advantaged or not tax protected investment accounts like a stock, brokerage accounts. You have business accounts, you have other investments. You're trying to protect your individual equity and not necessarily the equity, just the equity in the rental property. And that's a key distinction because you might have $500,000 in investable accounts and you only have 50,000 in this LLC or 50,000 in the rental property. But it's not about the equity in that property. You're trying to protect your owner's equity. And that's really key to understanding is what are you trying to protect and what are your options for achieving that? We form dozens, I don't want to say hundreds, but we form dozens of LLCs every month for investors across all 50 states. And we're probably going to need a whole new webinar just on Series LLC because that's kind of a ripple or a distinct type of LLC. But in general, highly recommend the LLCs. If you have a situation that you're concerned about your equity, this is not a normal type of passive investment. If I put 50,000 into Apple stock, I know that my exposure is limited to 50,000. Whatever my basis is I put in, that's it. When you're buying a piece of real property and you're engaging in people with contracts and there's a direct ownership of the business, you have some risk. It is a riskier investment with a corresponding increase in return. I think real estate is one of the best investments. That's why I choose to invest in commercial property, single family rentals, individually myself. I believe that the benefits outweigh the risk, but it's important to do your homework and understand what are your options and what is the criteria for when pulling the trigger on creating an LLC makes sense for you.
And Ron, let me just piggyback on that. My advice often to clients is that, hey, all things being equal, for all those reasons that you just mentioned, if you can get that property in an LLC, then go for it because, I would think it's just going to help you sleep better at night, if nothing else.
For sure.
So, regardless of the tax treatment, especially for that single member where there's really no major tax implications, all things being equal, why not?
Yeah. And again, I would say, let's take that W-2, investor. They have 1 or 2 rentals. I'll probably still recommend that they don't need to do an LLC if they have a long-term tenant because those tend to be the lowest risk profile. Again, it's also going to depend on what type of area. Is it a class A suburb, with great schools, 10 out of 10 star rating schools? Or is it a class C property that, again, even if you have a long-term tenant, they may have more visitors over, they more have people that are looking for, an easy payday with a personal injury type of lawyer. Those are 2 different situations that, yes, they're both long-term tenants, but not all long-term tenants are created equally. So let's talk a little bit about flipping. So this is like the BRRR method, buy, rehab, rent, refinance, and repeat. I don't know if that refinance is optional, but tell us about some of those, deductions or, would you recommend, do you see an LLC because you have a lot more expenses? You have a lot more line items?
So for the typical BRRRR, I believe that's more of a buy and hold. It's just simply a way of scaling up. Is that correct, Ron?
Sure.
Yeah. So with that, I would say it's sort of the same type of thing. Just if a person's going to be scaling up, especially with LLCs, then I would just say that it's really important to have the bookkeeping strategy in place, with having an EIN and running all transactions
Right.
for all those properties through the EIN's bank account, and really try hard not to commingle the funds. I mean, I'm sure you deal with this a lot as well on the liability side, but on the tax side, it's simpler when it's a single member LLC. But when you add another partner, and could be, maybe this would be a good time to speak about multiple members in an LLC, but when you add another member, especially, it's going to be critical to keep those, both the bank accounts for the LLC and each individual personal bank account separate, as well as LLCs from other LLCs separate, and really try hard not to commingle funds. I mean, a lot of the problems we see comes when people are commingling funds and having loans in one LLC and holding property, holding the title in another LLC, et cetera, et cetera. It becomes a nightmare on the bookkeeping and tax side. It can run up costs pretty high. Best way to keep that bill lower and to keep yourself in check is really just to be vigilant about not commingling funds and treating that business like a business.
Yeah, absolutely. You know, I would say those are my favorite types of clients that have, you know, the prototype, they tested out how they want to invest, and then they're looking to scale with a system that allows them to. And again, you can keep your legal bill down by telling me exactly where you are now and where you want to go. And then I can recommend a LLC structure that minimizes your liability, but it also gets you efficiently to where you want to go. And, you know, when you start bringing in other partners, it's imperative that you have a lawyer review or draft your company agreement, because that is legally binding. It is a contract between members. And when you start taking other people's money, when you start having returns that need to be paid and you need to have an accounting, it's really critical to avoid disputes and unhappy partners or unhappy investors who might, you know, think that there was more profit made on a house than there really was. And if you don't have the good bookkeeping, you know, again, I see good bookkeeping as a way to prevent disputes, because I might feel like we made more money on this, but if I can produce detailed bookkeeping for the last 6 months, I'm not going to file a lawsuit. I'm not going to have an attorney file a demand letter if all the records are in good shape. So real briefly, we could talk a little bit about short-term rentals. I think a lot of the concepts are similar, because for short-term rentals, I see a lot more liability. You have transient people. You're exposing yourself to a ton more, you know, probably 30% or 40% more tenants or visitors versus doing the due diligence on one long-term tenant. And so that's a difference. With short-term rentals, you just get so much turnover. That's what creates the risk. It's not necessarily the type of home or the type of use. It's how many different people do you have to gamble on every single time. So how many expenses, how many line items do you see with short-term rentals?
Yeah, so short-term rentals is actually interesting, because when you get to the short-term rental market, so then you have some other options if it's held in an LLC. And it really depends on how the short-term rental is being treated. If the short-term rental is providing something like hotel-like services, maid services on a daily basis, or concierge services, maybe a pickup from the airport, something like that.
Yeah. Yeah.
So then it actually has, the LLC could have a separate tax treatment. It's going to be more of an ordinary income, and that would carry with it some self-employment taxes. Now, along with that comes some other options for tax mitigation. You know, then you get into some other options, maybe like a solo 401k or some other things that we could potentially talk about another time. But that active income allows for a different type of tax treatment, you know, again, based on guidance from your CPA and your attorney. An S Corp might be an option as well. So an
Because
S
the
Corp,
revenue is higher, because your revenue and expenses will be higher. Yeah.
correct, exactly. Typically for the short-term rentals, it's going to cash flow much better. And in that case, particularly someone who's scaling up, they might want to consider an LLC to elect something like an S Corp status. That S Corp election, and again, it's an election that you make on that tax return, would then allow for the mitigation or the reduction of self-employment taxes. So there are some benefits, tax benefits to an LLC that does elect for an S Corp, but that would again be something that with more active income, like
Right.
short-term rentals that are being run like a hotel. If they're being run more like the traditional type where folks are just staying for a certain amount of days and the maid comes in afterwards and there's no real hotel-like services, so that would typically go on the Schedule E as well as passive income.
Well, and I think it's interesting because what I'm seeing from my clients is two things really. It's starting to scale. So the operators that are good at doing short-term rentals, the marketing, the decor, the description, the photos, all that stuff, they're starting to scale. Other people want to put their money with them and they're able to buy up more properties, get the economies of scale, reduce their prices for certain things of their expenses. And on the other hand, they're also starting to market directly. So everybody knows now kind of what a short-term rental is. So they don't need to advertise on the platforms of Airbnb. They're doing their own websites. They're getting Google SEO that if you search for Hill Country short-term rental, you get a lot of individual property websites that are not Airbnb. And you can cut out the middleman because they've worked really hard to establish the industry or the knowledge about what is this? Is it safe? How much does it cost? And I think that's really fascinating because as you transition, you're creating more expenses, yes, but you're cutting out Airbnb. On the back end, I'm protecting them by using the money that they would have paid to Airbnb to create their own liability protection. And then you're providing the tax accounting that is cheaper than the Airbnb alternative, which basically just gives you a 1099 and says, now you figure it out. So that's great. I mean, I think it's definitely a trend. Whenever you have disruption in an industry, like we're kind of seeing with coronavirus, COVID-19, there's going to be some winners and losers, and people who are really over leveraged with their short-term rentals and then their occupancy goes to 10% or zero, you're going to see the weak hands kind of bow out of the market, and other operators who do have cash reserves, who aren't over leveraged, they're going to be able to buy those units at a discount. And so it's really fascinating to me to be able to see this. I think the last recession, I really wasn't plugged in enough to the industry and to the clients to know who the winners and losers were going to be, or how people responded, how people reacted. And now this time, again, I'm not going to call it a recession, but it's a little bit of a shakeup. There's chaos. And we're seeing the people who are really over leveraged, feel some pain. So let's jump in. This is going to be kind of the final segment. I want to talk about costs. And again, none of this is binding. This is not a formal quote. What I do want to give people in this webinar, you've listened to us. We've talked about all the great benefits, all the situations. How much is this really going to cost me? What does bookkeeping cost for that W-2 investor with one rental property and a long-term tenant? And, let's say no property manager. Let's say they're doing some of the expenses monthly.
Yeah, I mean, typically for that type of client, we can actually just train them on how to keep their own books. If it's a single member LLC, we provide a bookkeeping template, a spreadsheet, and then just kind of point them in the right direction of how to keep that. They don't really need to outsource that bookkeeping.
Right.
It's the folks who have multiple properties, or an S Corp or partnership, more of a complex structure. So they would need some bookkeeping assistance, which we could provide, and we would do that on an hourly basis. Our current hourly rate is $110 per hour, which we break into 15-minute increments for bookkeeping. We also provide QuickBooks coaching and training. So folks who want to save on some costs, we can actually just provide some training and some troubleshooting for them to do it on their own. and that can reduce the fees for the bookkeeping.
That's great. That's great. So, so we're looking at, yeah, a few $100 a month or $100 a month if the entries are pretty basic. And if you don't want to even do that, you can pay for the training and do your QuickBooks Online to do your books yourself, and then just submit them to you for the return. You know, I think that's great. I don't have any training like that per se, but you know, just roughly for the LLC formation, you have filing fees. These are going to be in the range of $50 to $350. My attorney's fees range from $500 to $1,500. And if you do already own a property, then we do those deeds and the recording. And you mentioned something earlier. We do not do quitclaim deeds. So those are a big no-no in the legal world. And I know a lot of people hear about them, and conceptually they kind of get the job done, but we don't draft them. I think that they're a terrible instrument. And what happens is the quitclaim doesn't affirmatively transfer any interest. It is basically a disclaimer saying, well, if I own anything, I'm going to give it to you. And the problem is that it causes a real headache for title companies. So when you go to sell later, the title company most likely is not going to accept that quitclaim deed, and they will go back to the original grantor and want a warranty deed. And it can be a special warranty deed. That's what we typically use, but they don't like quitclaim deeds because it doesn't affirmatively prove title. So just a minor correction and good, you know.
Yeah, I always wondered about this, Ron. So when a client would quitclaim their deed, and you know, we never make that type of recommendation. But if they were, but they still hold their loan in their private name, so now they have the title in the LLC's name,
yep,
but they have the loan in the individual's name. Are they even having any asset protection? Is their liability limited in that case at all?
Super interesting scenario. It happens a lot. And basically, if you're Googling the words, it's a due on sales clause. It's a clause that's typically in your loan agreement that says you cannot transfer the collateral out of the borrower's name. That's in essence what it says. And if you do that, that's a breach. You're in default of your mortgage. The bank can call the loan due. They have a couple options. They can either make you transfer it back, which negates all of your asset protection. They can call the loan due, which means you have 30 days or something to pay them off, or really it's refinance the collateral. And that's what the bank can do. Now, there's a third option too, that certain Fannie and different federal backed, if the loan gets sold to them, they have an exception for single member LLCs. So you'll have to look at your loan docs, see if there's a due on sale clause. Typically there is, but read the conditions and the circumstances about that. And then see if you violated, or see if it's an exception allowed by Fannie. This was a regulation in 2017 that they allowed certain transfers to go through. So I know I didn't answer your question, but the short answer is yes, you do actually get asset protection if you transfer it to your LLC effectively. If you effectively transfer it, you do have the LLC protection. However, you're not in good standing with your bank. If you violate that due on sales clause, and again, I could do a whole webinar on whether these things are actually called, what are the economic motivations, who's holding the note, and I can't really say, is this due on sale clause going to be enforced? That's a very complicated question. Depends on if they're holding the note on their balance sheet. You know, you have credit unions, you might have a small regional bank. Is it securitized? Is it bundled up and sold to somebody else? Because a lot of ways that they catch it is you'll get the notice of insurance, and the insurance, you know, it's a requirement of your loan that you have to have insurance. And if you get the insurance issued to your LLC, which is now the legal owner, they get notice of that insurance change, and then they've got their work is done for them. They don't have to do any research. So again, I should do another webinar on that topic, but short answer is yes. You know, if you do transfer it, you get the legal protection from an LLC, but you're not in good standing with your bank, with your lender, who may call your note due. They may just want you to refinance at a commercial rate, just a higher interest rate. And you might see that where if your loan was taken out in a very low interest environment, and interest rates are climbing, they're going to want you to readjust, refinance to market level. So sorry for that segue. Great question. My last thing I do want to say is, there are very little legal costs for ongoing maintenance. I provide a form for everybody to do their annual meeting minutes to stay in good standing with their LLC. You can do that yourself, or you can pay us like $250 to do the minutes. You may have a franchise tax return in addition to a state income tax return if you have one necessary. And again, it really just is a question of time. It's usually not a tax due. So in Texas, there's a franchise tax. It takes about 15 minutes to file online. And if you're below 1.1 million in revenue, there's no tax due. Some other states will have an annual filing fee of $25 to $150. So I just did want to put those numbers up there. You can see like a little summary here. I will put up an Excel right there. Yeah, so, I hope everyone has found it useful. We have a question from one of our chat participants. So yeah, have I seen a bank? Yes, absolutely. I have seen a bank call the note due. But again, my perspective is skewed in two major measures. I see tons of investors. I'll probably talk to 100 investors in a month. So I get a much broader range of the market. And second of all, some of those people who talk to me have already had a letter from the bank. So I do see this, and I might see it at a 10% rate. But if you think that people only come talk to me when the bank has sent them a letter. So Jack, to answer your question, yeah, I see it, but I'm kind of like the doctor. People will come to me when they're sick. So I tend to think, oh yeah, this problem's everywhere. When in reality, I know that there are probably hundreds of other loans that have been transferred without having calling the note. So take it for what it's worth. It does happen. It's not zero, but I probably see a higher percentage just by nature of my job. So we'll probably wrap this up for the video. I can kind of open it to questions. Daniel, I know if you have a little bit of time, you can stick around. But if you guys want to use the chat box, we can take a few questions in the chat. But I do want to thank everyone for turning up today. This will be available on my YouTube channel. I'm just going to take the video down and I'll have it up probably in a couple days. But we'll make it shareable, and we'll email it to everyone who attended as well. Daniel, you want to add anything, or?
I just wanted to, first of all, thank you again for arranging this. It's wonderful to do this with you. And I would say, it's really critical to have these conversations, both with your legal counsel and your CPA. And just to reiterate what we said at the beginning, not always are those two going to see eye to eye, because the goals of each might be different. But to balance that, to balance the legal concerns and the tax concerns, that's the job of any savvy investor. But hopefully you are engaging with professionals that are looking out for your best interests and will help you to come to that reasonable conclusion about whether or not that LLC is going to be beneficial for you. And if so, what's the proper tax treatment for that?
Yeah, absolutely. And I think the final leg of that conversation, you have to balance your tax liability, your legal liability, and then your investment return. I think that's another leg that we don't really talk about. There's no service providers for real estate. Oh, you should be getting an 8% return on this property, or you should be willing to spend a little bit more and get 7.5, 7.7. It's really hard to decide from the owner's point of view, how much financial return should I be getting? And I think working with service professionals like Daniel and myself, who are also investors, we can tell you what we would do in this situation, because we also do own rental properties. And that's a huge piece of advice that I love sharing with people, to say, well, on my single family rental in Frisco, Texas, we don't do this. I'll tell you, we don't have that one in an LLC, because it's no pool, it's great tenants, it's a great school. I just don't even need to deal with that extra franchise tax return because I'm already filing about 8 a year for my different investments. Airbnb, LLC for sure. And that's what I do. I think that the risk is so high. I put Airbnb into that bucket. If I was doing BRR, if I was doing renovations and I had contractors coming in and out of my house, I had people smoking and, throwing their ashes, 100%, LLC. I do not want to be liable for a fire at my renovated property, that sort of thing. So what's the best way to get in touch with you, Daniel? Website or email?
Yeah, check out our website, myonlineaccountant.co. That's the best way to check out about our services. Otherwise, you can shoot me an email, danielh@myonlineaccountant.co.
All right, perfect. Well, thank you guys so much for joining us. Like I said, this will be on the internet, rehosted, and share it with all your friends. And feel free to reach out with any questions. Thank you, guys.